Most traders chase price. A smaller group understands that price is merely a noisy surface over a deeper structure of cost, consensus, and time. In this episode we strip trend down to 3 geometric and statistical layers: slope regime, consolidation dynamics, and the alignment of market participant cost bases. When you see a chart, you will no longer see a wiggly line, you will see an ecosystem of expectations. We'll examine why some trends run for quarters while others blow up in days, how congestion zones act as valuation anchors, and why moving averages are not lagging indicators but sensors of cost equilibrium. By the end, you'll have a unified framework that doesn't predict the future but tells you, probabilistically, where the path of least resistance lies. Before we can categorize trends, we need a universal yardstick. Slope is simply the ratio of price change to elapsed time. But that definition hides a critical normalization. If we compare two assets without adjusting for their scale, a $10 move in a penny stock looks steeper than a $100 move in a large cap. The solution is logarithmic scaling, where equal vertical distances represent equal percentage changes. Moreover, we must fix the observation window. I use a 5-year window for structural slope and a 1-year window for tactical slope. With these two choices, log price and fixed horizon, every trend becomes comparable, whether it's soybeans or the S&P 500. Once slope is normalized, we can map trend phases onto 5 intuitive regimes, roughly analogous to angles on a clock face. From 3 o'clock to 2:30, price moves sideways in a congestion zone. From 2:30 to 1 o'clock, we see a steady, sustainable uptrend. From 1 o'clock to 12, the slope steepens into an acceleration phase, exciting but mechanically fragile. The same logic applies on the downside. 3:30 to 5 o'clock is a stable downtrend, and 5 to 6 o'clock is a climactic plunge. These categories aren't just descriptive, they predict duration. Shallow slopes can persist for years, while near vertical slopes inevitably invite mean reversion, as we'll prove with cost divergence math. Congestion zones look dead, but they are where the next trend is built. When price oscillates within a well-defined range for at least 6 months, something critical happens: the cost bases of all recent participants converge. Early buyers and late sellers gradually trade at similar prices, compressing the spread between short-term, medium-term, and long-term moving averages. In a healthy uptrend, short-term cost sits above medium-term cost, which sits above long-term cost, a configuration that rewards early entrants. In a congestion zone, by contrast, these cost levels flatten and intertwine. The zone acts like a spring. Once it breaks, the direction is often determined by the larger macro trend preceding the squeeze. How do we know when a congestion zone has unified costs sufficiently? I quantify it by measuring the spread between the highest and lowest moving average among my set. I track MA20, EMA20, MA60, EMA60, MA120, and EMA120. These cover roughly 1 month, 1 quarter, and half a year. When the longest and shortest of these averages differ by less than 2%, the market's average cost has been squeezed into a tight knot. At that point, any breakout is likely to be explosive because there is no large pocket of trapped capital to absorb momentum. The formula isn't prescriptive, it simply flags when the cost heterogeneity has collapsed below a critical threshold. Empirical structure suggests that the longer the cost unification phase lasts, the larger the eventual directional move. This relationship emerges because extended sideways action burns out impatient capital and transfers assets to stronger hands, who then require a larger price incentive to unwind. Using a sample of 150 congestion episodes across major equity indices and commodities, we see a positive correlation between the length of the range-bound period and the percentage move after a confirmed breakout. The chart illustrates the average subsequent 6-month return grouped by congestion duration: short, 3 to 6 months, medium, 6 to 12 months, and long, greater than 12 months. The effect is most pronounced when the breakout aligns with the prior macro trend. We don't guess the direction, we position for the moment cost alignment flips into a directional hierarchy. The core rule: enter only when the moving averages transition from a tangled ribbon into a multi-timeframe fan. For a long trade, MA20 must rise above MA60, MA60 above MA120, and the spread between them must begin to widen. No premature entries, no bottom picking. Equally important is the invalidation condition. If the MA20 group crosses back below the MA60 group, the nascent bullish alignment is broken, and the position must be exited. This isn't a prediction, it's a disciplined response to changing cost structure. Patience is the entry fee, the cost of sitting through false starts is accepted as part of the strategy. A genuine breakout feels relentless, price rarely returns to the breakout level, forcing hesitant participants to chase. By contrast, a false breakout snaps back inside the range within days, often trapping breakout traders. Our framework distinguishes the two by observing two sequential actions on the opposite side. For a bullish false breakout, price surpasses the recent swing high but immediately reverses and closes back inside the range. Then, critically, it breaks below the 20-period MA group and that MA group bends downward. The combination of these two actions shifts the probability distribution toward a downside resolution. The market is signaling that the bullish impulse lacked genuine demand. Parabolic trends, near vertical slopes, cannot persist because they drive price too far from the market's average cost. The degree of divergence can be measured as the percentage distance between price and a long-term moving average, say the 120-day MA. When this divergence exceeds 2 or 3 standard deviations of its own distribution, the probability of a snapback rises sharply. The underlying mechanism is not magic, it's the fact that every buyer at an extreme price is eventually matched with a seller who wants to take profit at that mean reverting level. Large divergences also coincide with volume spikes, indicating climax distribution or accumulation. When a trend steepens dramatically, two consequences become inevitable. First, price deviates sharply from the 120-day moving average, the cost anchor. Second, trading volume explodes as conviction clashes with profit-taking. Every transaction requires a counterparty, so sustained high volume signals that a large pool of capital is exiting even as new capital enters. This combination, extreme divergence plus volume climax, is the market's way of signaling that the current slope is unsustainable. For a trader who missed the acceleration, the rational response is to wait. For those already in, the exit signal does not come from the slope itself, but from the first lower-level structure that threatens to reverse the MA direction. A common error is to assume that a moving average turns down as soon as price drops below it. Not true. For a simple moving average of length n, its direction tomorrow depends on whether today's price is higher than the price being dropped from the calculation n days ago. This old price is called the discounted price. If current price stays above the discounted price, the MA will continue to rise even if price is below the MA. This principle gives us a forward-looking edge. During a pullback in an uptrend, we can estimate how far price would have to fall to flip the MA direction, and thus define a structural invalidation point independent of arbitrary levels. No matter how dramatic a price spike or crash appears, a genuine trend reversal does not occur in a single bar. It unfolds through 3 sequential structural breaks. First, price must break a key moving average. Second, that moving average must begin to flatten and curl in the opposite direction. Third, a shorter moving average must cross a longer one. Until all 3 occur, the prior trend's cost structure remains intact. This 3-step filter prevents premature counter-trend entries and forces traders to wait for the market to prove its intent. It's a probabilistic gate. Most sharp reversals attempt the first step but fail at the second or third. Reversals don't start on the weekly chart, they germinate on the hourly chart. A new trend begins as a short-term alignment of costs on a lower time frame, which then diffuses upward. This diffusion principle contradicts the old idea that larger time frames dictate smaller ones. Instead, we watch for a bottoming or topping pattern on the hourly chart, followed by the establishment of a minor-level MA fan. When that lower-level alignment appears while price is still within the pullback zone of a larger uptrend, it offers a high-probability entry with a tight risk point. In downtrends, the same logic applies. A top pattern on the hourly chart, with bearish MA alignment, provides the shorting opportunity. In a confirmed uptrend with parallel rising MAs, pullbacks to the medium-term or long-term cost zones are opportunities, not threats. When price touches the 60-day EMA group or even the 120-day EMA group, compute whether the discounted price still supports an upward MA trajectory. If yes, look for a minor bottom pattern on an hourly chart, such as a double bottom or a bullish MA cross, and enter. The stop is placed below the low of that pattern. Statistically, these first touches of key MAs after a trend initiation often produce the most asymmetric risk-reward profiles. The same principle works in reverse for downtrends. Rallies to declining MAs with a bearish minor level pattern offer short entries. Armed with slope regimes, congestion dynamics, cost unification thresholds, mean reversion divergence limits, and the three-step reversal filter, the market ceases to be a random walk. Trends accelerate, rest, and reverse in a constant dance of cost alignment and divergence. We now understand that a parabolic move isn't the start of something, it's the end of its own phase. A congestion zone isn't a waste of time, it's the forge where the next trend is hardened. And a pullback isn't a signal to panic but to assess whether the cost structure still points upward. These patterns are not crystal balls, they are probabilistic anchors that tilt the odds in favor of a disciplined, process-driven trader. We've moved from describing trends with clocks to quantifying the forces that shape them. By measuring slope, watching cost convergence, calculating divergence from moving averages, and tracking the diffusion of micro-level alignments, we make trading less about guessing and more about responding to objective structural signals. The market will always generate noise, but underneath that noise there is a slow-moving machinery of mean reversion and alignment that repeats across all liquid instruments. If this episode sharpened your lens on market structure, consider subscribing to DeepQuant for more mechanistic, evidence-driven explorations of how finance actually works under the hood. Leave your comments on which asset's cost structure you'd like us to dissect next. See you in the next deep dive. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.